Hello, it's Rhonda Thomas, and we're about to do Financial Accounting's Chapter 14's intro exercises. So if you want to join me, I have my screen on my spreadsheet for this. And then I also have the problems open in Cengage. So now that we have made our way through the accounting cycle, remember the accounting cycle is 10 steps. And you would think the last steps would be the financial statements. That's not true. The financial statements are actually the 8th step of that cycle. And the last two are the closing entries for a period of time, like a year, and also the post-closing trial balance, okay? So once we have the financial statements created, they really don't tell us much unless we start comparing the numbers that we found to something, okay? Comparing to something, right? So horizontal analysis, vertical analysis is one thing we're going to work on here. Whoops. And learn, all right? So if you get a little something about this on, and remember, I am going to test you on 11, 12, 13, and 14 on the final. It's going to be pretty much just like our other finals. So let me get this situated here, I think. All right. I think I'll start off with showing you what so it says horizontal analysis, okay? Horizontal analysis. I'd like to show you what horizontal analysis is, okay? It's looking at a financial statement and adding a little something to it so that you get more information. Okay, once again, chapter 14 is called Financial Statement Analysis. And I hope I am recording. I want to make sure that I am. Yes, I am. Okay. So let me go and show you an example of a horizontal analysis and a vertical analysis. Okay, I'm going to go to the ebook. For chapter 14, I'm going to the ebook. So I want you to see it. Actually, this is the PowerPoint. So let me see what we can see in this PowerPoint here a moment to identify horizontal and vertical. So just like, okay, I'm going to download this. So hang on just a second. Actually, and then I'm also going to go get the ebook because I want you to be able to recognize horizontal and vertical analysis. Horizontal means side to side, and vertical means up and down. Okay, so let me show you what it looks like from the ebook. So we have these financial statements. What do we do with them? We need to learn to analyze them and maybe make some interpretations. Okay, you need to learn the word liquidity. Okay, liquidity. Here is the definition. Short-term creditors, such as banks and financial institutions, are primarily concerned with whether a company will be able to repay short-term borrowings, such as loans and notes. As such, they're most interested in evaluating a company's ability to convert assets into cash. That's the definition of liquidity. How quickly can you convert an asset to cash? Well, cash is already cash. So cash is as liquid as it gets. Okay. Then the next thing would be maybe marketable securities or accounts receivable. How quickly can those be liquidated and turned into cash? Okay. And then you take your inventory and your other current assets. How quickly could those be turned into cash? And then finally, your fixed assets and your investments. How quickly could they be converted to cash? You'd have to sell them. It might take longer, and so forth and so on. So the liquidity of a business is very important in order to be able to pay bills, basically. Solvency is a word. Solvency. So what solvency means is long-term creditors, such as bondholders, loan money for long periods of time. Thus, they are interested in evaluating a company's ability to make its periodic interest payments and repay the face amount of debt at maturity, which is called solvency. So liquidity pretty much allows you to pay your short-term obligations, and solvency to make periodic interest payments and repay the face amount of the debt at maturity. So these are longer obligations that you would have to meet. And if you're not doing very well up here, you probably won't be doing too well here. So I'm going to highlight the word meaning of solvency. Okay. And then finally, profitability. Profitability. Investors, such as stockholders, are the owners of the company. They benefit from increases in the price of a company's shares and are interested in evaluating the potential for the price of the company's stock to increase. The price of a company's stock depends on a variety of factors, including the company's current and potential future earnings, such as investors focus on evaluating a company's ability to generate earnings. That's also called profitability, right? Profitability. So what we're going through in this chapter are several different measures of these three main topics that we need to analyze for a business. Okay, so we have analytic methods. We have ratios. Ratios involve a formula. Okay, ratios involve a formula. So here is horizontal, vertical, and something called common-sized statements. Let me show you what one looks like. Okay, this is a balance sheet, and it is set up under what's called horizontal analysis. Okay, horizontal analysis. Notice what we have here. We have a balance sheet. We have 1 year of a balance sheet, and then the next year of the balance sheet. Look what we're doing horizontally. Horizontally, we are subtracting the old from the new. Okay, the old from the new. This is the old, this is the new. Okay, and we're going to get an amount. So current assets, for example, from this year to this year actually increased by 17,000. So I think you can kind of see that this is some of what we were doing in the cash flow statement if you've had a chance to work on that a little bit. And then once we know the increase or decrease, then we're going to find the percentage of that number of that increase or decrease. So I want to put down a formula here on my spreadsheet. So if you ever want to find increase or decrease amount, okay, increase or decrease amount of something, right? You say, oh, this is too easy. Why are you teaching us this? Well, some people don't quite understand this. So here's how you would look at it. And a decrease, an increase or a decrease is going to be an amount in dollars. Okay, it's going to be in dollars. So you would take any newer amount and you would subtract any older amount to find the amount of increase or decrease. Okay, The second one is increase and decrease as a percentage. Okay, increase and decrease, increase or decrease amount in percentage. Okay, so you just take that one we just did, right? So let me put it down. New minus old, and then you're going to divide by old. Okay, so one more step to get that percentage amount. And then you're going to line it up horizontally throughout this balance sheet, right? So once again, if we're looking at this balance sheet, here is the new amount, here's the old amount. When you do the subtraction, this is the formula, right? And so let me put formula here. Let me move this over. And I'll put the word formula. This is a formula that one of my former accounting teachers taught me, and I'll never forget it, right? Because it's helped me so much from that point on to learn it this way. Okay, so I'm trying my best to make sure, hopefully, you've learned a couple things this semester, right? So once again, the formula for finding out an amount of an increase or a decrease in dollars is simply the new minus the old. And if you always do new minus old, you'll actually get, if it's a increase, it's a positive number. If it's a decrease, it's a negative number. So I'm explaining horizontal analysis here, which is what we're getting ready to do. Horizontally means side to side. You're analyzing something side to side. So all of these in this balance sheet have been analyzed for an increase or a decrease. We did a little bit of this to get that cash flow statement going. If you've done some of that already. If you haven't, expect to see some of this. And then the final piece on the right in this analysis is a percentage. This is what they call a percentage change. How much did current assets change? Yes, we know they went up $17,000. Well, that was a 3.2% increase. Sometimes percentages give you a better picture than just an amount, okay? A lot of times percentages are the amounts that allow you to compare one year to the next. Sometimes the percentages is the formula that allows you to compare one company to another. Okay, so once again, increase or decrease amount. I'm going to highlight this on my screen. Okay, and then the formula that goes with it is right below. Okay, and this is also known as a percentage change. So I want you to make sure that if somebody says, what's the percentage change? You say, I've never seen that before. Yes, you have. It's just they're calling it something different. So percentage change is another word for this, right? So I'll put AKA, also known as percentage change. And once again, the formula is new minus old divided by old. So let me give a little more space here between our information so that you can see it better. There, that's better. New minus old divided by old will give you a percentage. New minus old will just give you the increase or the decrease in dollars. Okay, having said that, let's go ahead and go into the problems. I know I've taken quite a bit of time to explain some of this, but it is necessary sometimes. So I got to go back into our intro problem. And the first one we're going to work on has to do with horizontal analysis. Okay, so we're going to compare accounts payable and long-term debt balances for a company as follows. Okay, so and I'm just going to go, I'm going to use this here. So hang on just a minute. And I'm going to use that formula here. Okay. To remind us what we have to do. So this is number, so I'm going to throw these over here. Can't do that to a merge cell. Okay. It doesn't like it. Well, then we'll unmerge it. Okay. Okay, now let's see if we can bring this in. Nope. Okay. All right. Well, anyway, here is the formula. Let me try one more time. See if I can bring this over to this other sheet. Yeah, there it is. Okay. And then we will put in our information for any kind of calculations that we need to do. Okay. So this is number, so we have 11. Yeah, we have 11 questions. Okay. So the first one's going to be number 1, of course. And we'll put that in as, I think I used orange most of the time. Yeah. Okay, so number 1 says we have accounts payable, current year, previous year. We have accounts payable and long-term debt. So this is going to require putting in some numbers from the financial statement. Okay, so let me get started here. So I'm just going to put these. So I'll put current year and previous year. So current year for accounts payable, I'm just going to abbreviate a little bit. Okay, is $100,050. The year before that was $115,000. Okay, so we need to know. Okay, so let me just go ahead and fill these in. Let me move this over so that it's not in the way, because we want an increase or a decrease. Okay, and then they want long-term debt also. So let's put long-term debt in. 129,720 and 141,000. And so we can do formulas here, which is nice. So the increase or the decrease in dollars. So I'll put dollars here. And then the percentage change. Okay, the percentage change. So percentage change from one year to the next. So we always use the current year first and subtract the previous year. So my problem is current year minus previous year. What happened? It looks to me like accounts payable decreased $14,950. So I'm going to put the amount of the change right here, and it decreased. And how do I make that into a percentage change? Well, we divide by the old, right? So I've got half of the formula sitting here in the slide, or in the cell beside me when we found out that that was a decrease. But now I want to get the percentage change. So what I'm going to do is I'm going to take what we just did and divide by the old, right? So I'm going to put the word new, because we're using that word, and old. And I'm going to turn this into a percentage. And I also want to see how many decimal places they want. Let me extend this out. All right, I got 2 decimal places. So looks like we had a percentage change, and it says enter all answers as positive. Okay. All right. So our accounts payable actually went down 13%. Okay. I did put negative here, but they don't want you putting the negative here. I don't know why. I'm just going by what they tell us. Okay, let's do the same thing now for long-term debt. Okay, long-term debt went down as well. Well, how much? What percentage did it go down? It went down 8%. Okay, so we got to put the answer in 11, and we want this. The amount of the change is 11,280. It is a decrease, and that percentage change is 8. Okay, so I want you to be able to calculate a percentage change and an amount change pretty easily. And if you think about it, I don't think that's too bad. You just have to practice. I think the hardest part is to remember to start with the newest number. Okay, the newest number, not the oldest. Okay, you always want to subtract the old from the new. Okay, that is pretty important. You've got to do that or it won't come out right. Okay, I'm putting these all up here. So let's go on to the next one then. That's horizontal. So when we were looking at this horizontal balance sheet, they've done that for all of these lines. You just fill it into a spreadsheet, pull that formula down. Now this formula is going to add all these up, so be careful, but it should be the same number going both directions. You say, okay, and this starts to tell us things, right? We like this one here on my board. It's telling us that we have grown from last year. So how do you know? Because you got more assets now. Okay, got more assets. But we did get rid of some long-term liabilities. Long-term investments. So we sold some. We sold some property, plant, and equipment. Our liabilities went down. Our long-term liabilities went down. So you could say that when you look at this Lincoln Company, you could say that from year 5 to year 6, it looks like there's some positive things going on, right? And you wouldn't know that if you didn't have two sets of numbers to compare to. Okay, the financial statement's not going to tell you that without doing this horizontal analysis. Now, this is an income statement, horizontally analyzed, horizontally. Okay, so let's go to the next one. Now we're going to look at vertical analysis. Vertical. Okay, so horizontal is side to side, vertical is up and down. Okay, so we're going to be doing some kind of analysis up and down. So here we go. I'm going to push this down, and I wanted to go ahead and put that this was horizontal analysis that we were working on. So horizontal analysis is all about percentage change. What's going on? What's going on? How come you're not following?
Oh, I just found my computer.
Very good. I didn't know you were still working. I'm sorry. I was trying to figure out what was going on. Okay. Very good. That's fine. I'll let you be. All right. So horizontal. Let me show you what horizontal looks like. Okay. I mean, vertical. Vertical is up and down. So here is a vertical analyzed balance sheet. You say, what is happening here? Now, we don't want to know the change as far as whether an account increased or decreased, but here's what we do want to know. So most of the time on a balance sheet, if you're going to analyze it vertically, you're going to take in this row here, I mean this column here, you're going to divide every number by total assets. So every number, all 4 of these assets are going to get divided by total assets. And you're going to get a percentage. All of these are going to be divided by total assets. All of these are going to be divided by total assets. So basically what this is saying is there are 4 categories of assets, and from last year to this year, our current assets have gone up in the amount of assets we have. So this is analyzing the percentage of total assets on here. Okay, so that's how you would do it. You would divide everything in one column by one amount. Okay, once again, everything in this column is being divided by total assets. Do you know how I know? Here's how you know. If you're looking at a vertical analysis, you look to see which line has the 100%. Because that's itself divided by itself. Yes, you also get that down here, but remember, this is a balance sheet. So both sides are supposed to balance. But the one number that I always hold true to a vertical balance sheet is everything gets divided by total assets. And then so you create a formula that will divide all of these by that one number. All of these are divided by this total asset of that particular year, okay? So if you're working on an income statement and analyzing it vertically, then you would divide everything by sales, okay? Everything in this column is going to get divided by sales. Everything in this column is going to get divided by sales. So that's what they mean by vertically, right? Vertically, up and down. All right. So let's go ahead. We have an income statement here. Okay. So I'm going to go ahead and put these numbers in. Okay. I got 1,234,000. We've got cost of goods sold of 752,740. And then gross profit. Remember, gross profit is subtracting cost of goods sold. So I'm going to double check that their numbers are correct before I move on. Okay, so I'm going to put sales and cost of goods sold here. And remember, we get gross profit when we do this. This is just a subtotal, and we subtract. So I am going to put a negative here to help you remember that we subtract. And then we simply just find out, yep, 481,260. Yep, that's right. So what we're going to do to put vertical analysis here is we're going to divide everything by sales. Okay, sales is going to get divided by sales. Cost of goods sold is going to get divided by sales, and gross profit is going to get divided by sales. And once again, this is vertical analysis. And this was horizontal. By the way, if you like this stuff, this is more what managerial accounting will be doing. Okay. Oftentimes, if you weren't all that crazy about financial accounting, maybe managerial will be more to your liking. For me, it all depended on the teacher. Okay, that's what mattered the most to me. The work didn't matter as much. It was the teacher and how willing they were to help me understand what's going on. Okay, so, all right, so I'm going to put a percentage here. So this is going to be a percentage, and I'm going to put what it is. It's the percentage of total sales. Okay, percentage of total sales, and I've got to turn it into a, yep. And all right, so then I am going to drag this down and it should fill in for me. Yep. And in case they want it answered to the nearest whole number, just for fun, I am going to increase the decimals there just in case we need that any other time. So here's what this is saying. You said, now we can't really interpret anything from this. We can't. All we can say is this. The vertical analysis, of course, sales divided by sales is going to be 100%. Now, here's what we can know. When we take cost of goods sold divided by sales, it looks like that for every dollar of sales, 61% of that dollar is the cost of what we're selling, right? If we subtract 61 from 100, these two have to add up to 100, okay? This is the percentage of every dollar sold that's the cost of what we sold. So we actually have a profit, a gross profit of everything we sell. We have a markup, right, of 39%, I believe. 39%, because once again, 61 and 39 have to add up to 100. Okay, so, and that's what this is showing here on my screen. Okay, so that's why that is. And that is vertical analysis, but they didn't give us another set from last year to compare it to. So you say, I don't know whether this is favorable or unfavorable. You could compare this to another company. Are we keeping pace with our competitors with our profit margins? I don't know, because I didn't get anything to compare, but we got it ready for analysis. Got it ready for analysis. Are you heading out? Okay. Do what? Perfect. Okay. Very good. Thanks for coming in. I appreciate it. Okay. Now we're going to go through what's called they're called current position analysis. Current position. So let's put this in. And one thing I want to mention in the book, there should be a page, which I'm going to find it, that has a lot of these formulas. A lot. Okay, so let me find the page, and I actually might make a copy of it and put it in the module in Canvas so that you have it ready to go. But I'm also going to show you where it's at in the ebook, because it's pretty important to see them. Okay, pages 7, you might write this down, page 723 to 725. I would highly recommend, okay, pages 723 to 725. Okay, these are your summary of analytic measures. Okay, some summary of analytic measures. And it continues, it starts on page 724 and it goes to 725. So this is called Exhibit 13, and it's the summary of analytical measures. All right, so we have liquidity measures. Okay, we have liquidity, which I already talked about what liquidity is. We have solvency measures, and we have profitability. So liquidity is, can you pay immediate bills? Okay, so this is liquid assets. It's your assets close to cash. Assets close to cash. How quickly can your assets be turned to cash? How quickly, I'm going to put this down, can current assets be turned to cash? Question mark. That's what liquidity is measuring. Okay. Solvency is how, or I should say, will the health of company be able to pay long-term debt? Okay, long-term debt. Will they be able to pay it? Profitability. Will Okay. What is going on here? Okay, will the company earn a profit and how much? Okay, so there's just some things to think about when you're thinking about liquidity, solvency, profitability. And I'm going to show you these in the ebook. And I may make copies of this and actually put it out in the module in Canvas. In fact, I just will, because I think it's that important that you be able to see these formulas. I bet there are a couple of you who haven't cracked the ebook. Have you gotten to the ebook ever? Nope. Well, there's a book out there.
Oh.
And I still think that we should be all having a physical copy of this book. But there's others that think that's too expensive. But I think we're doing ourselves a great injustice by not having the book. I don't ever do this class without my book, even though I know the ebook is out there. It's that important. Yep. Okay. If I had my way, I would make it a requirement that everybody who takes this class gets a physical copy of the book. All right, here we are, summary of analytical measures. Here is what it looks like. Okay, so I guess I can bring this in. Yeah, let me bring this into my spreadsheet, guys. Okay, so we'll have them at the ready to use. Let me go get my snipping tool. Yeah, it knows I'm looking for it. It won't let me put it on my taskbar, though. I don't understand why. Oh, well. Okay, I am going to snip this. If you wanted to go to the ebook and snip this, it probably would be a good idea. Okay, just a second here. I'm going to do this one more time. Because you can snip anything, really. I haven't hardly ever found something you couldn't snip. Maybe there is something, but okay. So let's try this one more time. And then I'll bring this into our spreadsheet here. So look, liquidity measures, 1, 2, 3, 4, 5, 6, 7. There are 7 of those. Solvency measures, there are 3. Right? Let's put this right here and we'll move it over. And in case we need it, we can make it bigger so we can read it if we need to. Okay, and then I'm going to also bring in the other one. Actually, what's happened? What happens when we do that? Oh, okay. Okay, all right. Let's go to this one now. This is profitability measures. How many are there? 1, 2, 3, 4, 5, 6, 7, 8. Okay, we want to bring this into the spreadsheet as well so that we can refer to it if we need to. Because I don't expect you to memorize these formulas, but what I would like you to do is if I ask you to calculate a formula, it would be a good idea to try to know how it works just a little bit. Okay. Practice, right? Practice. So we're going to practice these measures here and these measures here in this chapter. Okay. So that's pretty much what this chapter is about. Okay. So I'm going to leave them right here. And so the first one we're doing is current position analysis. Current position analysis. There's a current ratio and quick ratio. Okay, so we're going to use the formula here. Current assets divided by current liabilities, and then we're going to do one called the quick ratio. Okay, so I'm just going to put these numbers in. Okay, so cash is 472,500. Marketable securities, you say, I've never seen that before. Well, it's a little harder accounting, but it's securities that we've got as a business that we can sell anytime. We can sell them anytime. If we can sell them at any time, they're closer to being liquid than accounts receivable is. Up to now, accounts receivable has been the next liquid asset that we have. Okay, so I'm going to abbreviate here. Oop, not AP, AR. Okay, 193,000. And inventory. Okay, and then our accounts payable, that's our only current liability is AP. Okay, so, what we need to do is we need to find our current assets. Well, guess what? These are all current. Yep. So we've got to add up how many there are for current assets. And it's good to go ahead and label what you're finding because you might need it again if in a certain problem. So we're going to find current assets here. And we're just going to add these together. So let me draw a line here. All right, so now we're going to add these up. So current assets are $945,000, and we're going to divide them by 270. So our current ratio, right, between these, we would take our current assets and divide by our current liabilities, and we get a 4. Okay, so I want to turn that into, just want to make sure. See, I increased the decimals there. So it was rounding to 4. It says round your answers to 1 decimal place. So we've got to watch for those answers or we'll get it wrong. Okay, so once again, this is the current ratio. What this means is, by the way, this current ratio, the higher, more favorable. Higher is more favorable. Higher is favorable. That means if it goes lower, it's unfavorable. What this means is for every dollar of liabilities that we have, and I'm going to put this down, what it means, every dollar of liabilities, there are $3.50 of current assets to pay them. Okay. To pay, for every dollar of current liabilities, remember current liabilities is what we'll be owing within the year. For every dollar of current, I'm going to make sure I put that in, current liabilities, there are $3.50 of current assets available to pay. Yeah, current assets available to pay the liabilities. Okay, so 350 is what I've got for my very first answer. Okay, now the next one is called a quick ratio. Well, when you go do the quick ratio, you've got to learn what your quick assets are. So what are quick assets? Well, it says, and beside each one of these is telling you how these measures get used. So all of these measures your current position in your company, how well you can pay your bills, basically, with the assets that you have. So if you wanted to see what current assets are, you would look at each of these formulas are used in the book, and it tells you more about them if you actually look at it in the ebook. Okay, so we're looking for our quick assets. So I'm just showing you, and we are evaluating our current position, right? Current position. So here comes the quick ratio. So what are quick assets? Quick assets are cash and other current assets that can easily be converted to cash. Normally, they're cash, temporary investments, which is your marketable securities, and accounts receivable. All right. So you would have to know that because you are not going to include inventory for this next formula. You're not going to include inventory for the next formula. So I'm just simply going to copy this and put it in. And then I'm going to add it up. Okay, add it up. Our quick assets are 864. Okay, quick assets. And now I'm going to just use the current liabilities have not changed. Okay, this is your current liabilities. Okay, and I'm going to go back to the problem now. You're going to use this same amount for the divisor up here. So I'm going to do the formula for this current ratio because I do like to show how those numbers came about. So once again, 945,000 divided by 270,000 in asset or in liabilities. Yep, 270,000 in liabilities, current liabilities. There's the formula of how we got this 3.5. Okay, now we're going to do it again. We're just going to copy AP so we stay consistent. And this is going to be your quick ratio. Okay, quick ratio. And just like the other one, higher is better. Okay, so I'm going to borrow this and put it in. And I may not put this on every one of them. I'm just trying to kind of start you understanding what these are. So once again, this is called quick ratio. For every dollar of current liabilities, there are, now let me do my math here. So we take our quick assets and divide by our current liabilities, and we get a 3, but I want to add, okay, so we get 3.2, okay? So 3.2, okay? And once again, let me put the formula, how I got the number. I took my quick assets of 864,000 and divided by my current liabilities of 270,000. And that is how I got my 3.2. And what this is saying is for every dollar of current liabilities, there are $3.20 of quick assets. So this is even more current. How current are we? We're getting even more precise with quick assets here. Quick assets. What are the quick assets? Cash, marketable securities, or temporary investments. Please know this is another name for temporary investment. So I'm going to put also known as temporary investments. And that's one thing that always bothered me when I was learning this is why did they use so many different names for the same thing? So marketable securities is also known as temporary investments. So if you look at it in the book, it says temporary investments. So that's not saying temporary investments, is it? That's not the words they used. No, they should have used the same words every time, but they didn't. So they're just trying to make sure that you're well aware that that's what it can be called. You might have a test question about what are the quick assets. That would be an easy question for the test. Okay, so this was number 3. Yep. All right. So now I'm going to check my work and make sure it's right. Okay. So I'm sorry that one took so long. But now that we've got our formulas here, we're going to refer to them. Okay. So now let's go on to 4 and see if we can't pick up the pace a little bit. Pick up the pace. Okay. Number 4. Okay. So now we're going to work on accounts receivable analysis. Accounts receivable analysis. We've got sales. Okay, so I'm just going to type in what they're telling us. And we've got average accounts receivable. Now they've already averaged our accounts receivable for us. Average accounts receivable. If they don't average them, we have to have at least 2 accounts receivables to add together and divide by 2. So the average has already been calculated for you. Average already calculated. That may not be the case in any other problems in here. So you're going to have to understand how to average something. So then accounts receivable turnover. We also have a measure called days, number of days sales in receivables. You're going to find a percentage here for a number. Accounts receivable turnover is a number, okay? It's a number. So I'm going to put accounts receivable turnover. All right. And I'm not going to put the formula down. We're just going to go up and get it. The other one is called days sales in receivables. These two are related to each other. I'm going to put number of days. I don't know why they don't say that anymore. Number of days sales in receivables. I'm going to call it number of days. Days is sales. Days is? Okay, sure. Whatever. Sales in receivables. So like I said, these two are related. So here's what we're going to do. Let's go up and look. Let's see what the formula is. So accounts receivable turnover is your amount of sales divided by your average accounts receivable. Then the days sales in receivables uses that same average accounts receivable as the numerator and figures out what your average daily sales is. All right, so before we go any further, I want to know what our average daily sales are. So I am going to scoot this down and I'm going to put average daily sales and I'm going to calculate that. Okay, I'm going to calculate that. All right, so how do we calculate average daily sales? We take all of our sales and divide by how many days are in a year? 365. So 365. So there's our average daily sales. On average, we sell $3,272 worth of sales. All right. So let's go back to the turnover now. A turnover is a number. How many times? Number of times. How many times did we turn accounts receivable over? How many days does the average accounts receivable wait before it's paid, right? So I'm going to put number of days. This is the number of times that it turns over. Number of times AR turns over. So turning something over is getting rid of it, collecting it. In this case, we're collecting accounts receivable. Okay. So let's do the math here. Let's take the sales, which is going to become the numerator, and divide by your average accounts receivable. And there we have it. And do not round. Okay. Round your final answers to one decimal place. So I'm going to change this to a couple more decimals just in case. Okay. And I'm going to put beside it how I got this number. Okay. How did I get it? I took 1,194,440 and divided by 91,880. There's the number that causes this. This is the calculation I did. Okay. And remember, these are all in dollars. Okay. So I'm just saving a little time not putting in the dollar signs, but these are dollars. And what is this saying? This is saying that in 1 year, we collected accounts receivable 13 times. Okay. I don't know what our terms are, credit terms for our customers, but if our credit terms are 30 days, we're doing pretty well. We're collecting it. If we were collecting it every 30 days, it'd technically be about 12 days in sales. So we're going to be finding a number of days that's going to be less than 30. Okay, so here's how we find the number of days. We take our average accounts receivable and we divide by our average daily sales. Now I'm going to move this down so that I can show you the calculation beside it. I always like to show calculations beside because that way you can go back and say, what'd she do here? I don't remember. All right. So the number of days, one more time, we now use average accounts receivable as our numerator. Remember, the numerator is the top number, and you divide by the divisor, which is the bottom number. So our average daily sales, so 28 days. Yeah, I said it'd be less than 30 days. Okay, so I'm going to go ahead and make that 2 decimal places because I want us to be as precise as we can. So one more time, the formula that I used was the average accounts receivable, and I divided it by the average daily sales, which I've already calculated. All right. So this is the numbers that were used to get that number. So how many times did we turn accounts receivable over in the last year? We turned it over 13 times. Well, with that 13 times, how many days in sales? No, I'm sorry. How many days did it take for us to collect? Yeah, to collect the receivable. Okay, to collect the receivable. It's 28.1 because they want it rounded to the nearest 1 decimal place, right? So 28.08 becomes 28.1. Okay, so that's why I picked 28.1. Let me fix this. Yep, 28.1, and I'm going to put rounded to nearest, rounded to 1 decimal. There it is. Okay, so let's put these numbers in and see if we're right. I hope. Okay, so all right, let's keep going. All right, the next ones are going to be, we're going to basically do the same thing, but now we're going to do inventory. So one more time, what we just did was we analyzed our accounts receivable, right? Let me go back just a second. Let me go back to the one we just did. So this is accounts receivable analysis. There's basically two ratios to do. So accounts receivable analysis. Okay, now we're going to do this whole thing over, but now we're going to do it for inventory. So remember, accounts receivable and inventory are both assets. Okay, so instead of accounts receivable, we're going to use inventory. Okay, inventory. Okay, so let's go to number 5 then. Instead of sales, we have cost of goods sold, and instead of accounts receivable, we have average inventory. So let me fill these in. Cost of goods sold. You can always use COGS as your label for cost of goods sold. We got 920,000. Okay. Then we have average inventory here. Average inventory. Now they have already calculated it for us. It's 80,000. Okay, they've already calculated it. Okay, and then we're going to get inventory turnover. Okay, here's what they call inventory turnover. How often did we sell out of our inventory? The more we sell, the more we make, right? Yep. So we'll be calculating that and putting it here. So one more time, the number of times inventory turns over. Okay, and the more the better. Inventory. Okay, and once again, I want to use the phrase higher is favorable. Okay, because sometimes it's hard to remember. Well, if this is going up, is that a good thing? Yes. So this one, higher is better. This one, for the days that, how many days is it going to take to collect something? This one is the lower the better. Lower is better. Yep. So I forgot to put that down. So that goes for here too. Okay. So once again, higher is better. Lower is better of these. Okay. So let me take these out and let's figure out what we've got. Okay. So once again, our COGS are 920,000. Our average inventory is 80,000. And if we go up here and look at the formula for inventory turnover and days sales in,
Would like to talk about the
just a second. Sorry. He's going to have to wait. Okay. Where was I? Okay. We're going to do one called an average daily cost of goods sold. Just a minute. Let me tell my husband that I'm in class so he knows, unless it's an emergency. Okay. If it's an emergency, he'll let me know. All right. So let's do the math. We've got to do average cost of goods sold. So just like we did average daily sales, we're going to do average cost of goods sold here. All right. So this is this number divided by 365. Okay. So 2,521. All right. So here comes inventory turnover. How do we do it? We take the cost of goods sold and we divide by the average inventory. Okay, there's the number of times inventory has turned over in a year. So I'm going to put 11.50. Okay, 11 times. Let me put the calculation here. So this is $920,000 worth of cost of goods sold divided by average inventory of 80,000. Okay. So now let's do the number of days that it's taken us to number of days in inventory, not receivables, but inventory. Okay. How many days is it taken us to sell out our inventory? Okay, so what we need to do is use average inventory this time for our numerator. And then we're going to divide by the average cost of goods sold for, right, 3174. Here comes the formula. Here's what the numbers I used. I used 80,000 because that's the numerator on this one. The average inventory divided by the average cost of goods sold. That's the numbers I use to get that number. Okay, so I'm going to put this in and it says rounded to one decimal place. Well, this rounds down 31.7. So I'm going to put 31.7 right here. Always pay attention to what they want for your final answer. Okay, so you don't get it wrong. So if I didn't put the 30, if I put 32, it'll mark me wrong. Okay. Okay, let's go on to some others now. This is solvency formulas. Okay, and I'm going to go ahead and continue all of these. And then I'm also going to go ahead and do chapter 14's coursework so that it's out there for you. All right, so this is number 6. Okay, this is called long-term solvency analysis. So long-term solvency analysis. Okay, I'm going to put these amounts in. 1,333,000 long-term liabilities. Total liabilities. So they're pulling pieces from the income statement. I'm sorry, the balance sheet. Even though we can't see the balance sheet, they're pulling those for us. I'm going to go ahead and label these just so we know. Now, this is fixed assets, and it says net. Net means that accumulated depreciation has been subtracted. I'm going to put net means accumulated depreciation has been subtracted. That's what, if you see the word net there, which we do. Long-term liabilities and total liabilities and total stockholders' equity. Okay, total stockholders' equity. All right, so I'm going to scoot this over just a little bit so we can see all of this. Okay, so let's go find the ratio of fixed assets to long-term liabilities, the ratio of liabilities to stockholders' equity. Anytime you see the word ratio, ratio is a division problem. Yep, you're going to have to divide. Ratio is a division problem. So you've got to have a numerator and a denominator, and sometimes they're in percentages, okay? But they're not asking for percentages here. They just want us to fill it in, and they want it to one decimal place. Okay, so I'm going to put ratio of fixed assets. Okay, ratio of fixed assets to long-term liabilities. So some of these are very straightforward. I mean, you already know by just what they're telling you how to calculate it. But sometimes you have to go a little further. So, and then we want the ratio of liabilities to stockholders' equity. Okay, so what's the formula? If I go up here under solvency, there's the ratio of fixed assets. So you take your fixed assets net. Okay, well, it's already netted for us. But if it wasn't, we would have to subtract accumulated depreciation first. Then it's going to take the long-term liabilities. So we're basically going to divide fixed assets by your long-term liabilities for the very first one. And then the second one is just taking your total liabilities and dividing it by your total stockholders' equity. I always liked that one because it was very straightforward. There was nothing else you had to calculate before you did that one. All right, so back down here we go. So I am going to put this number out here, and then I'm going to show the calculation like I've been doing. So let's take so the first one is the fixed assets divided by the long-term liabilities. Yep. You're going to get a number, but you're going to need to change that number to more beyond a decimal here. So I'm going to do two. Always. If it tells you to do one decimal, then you need to get your answer into two decimals. You have to know what this decimal is in order to know if you have to change that one. Okay, always get two decimals or more. It's just a good practice. Okay, the second one then is your total liabilities divided by your total stockholders' equity. And you would get all of this from a balance sheet. Okay, I must have messed it up. Okay, so I want that. I want it divided by that. Yeah. So I got 1, but now I'm going to increase my decimals so that I make sure I have the right number. So now I'm going to put the amounts that I calculated. I'm like I said, I'm always doing that because I had teachers that wouldn't do it when I was learning this. They would just say, well, you just need to write it down. Well, this is me writing it down. Okay, this is me. So one more time, equals 1,333,000, dividing it. That's your total, or it's your fixed assets net divided by your long-term liabilities. Okay, that's the numbers we use to get to that. I could move it back now, just a second. I didn't know how much room I would need. Okay, let me do this again. No, I'm just going to leave them there. They're fine. All right, so then this second one, right? Let's put this in, 4.30. And I'm putting them in as two decimals. I'm going to see if it'll take it or if it's going to fuss. I'm going to find out. Okay, so then the second one to calculate this, let me move this down. 1. Nope, I'm just going to move it. I'm just going to redo it. Equals total liabilities divided by total equity. So remember, your liabilities and your equity are the second half of your balance sheet. So those are each of those the parts of the second half of the balance sheet. One is being used as the numerator and one is being used as the denominator. So our liabilities are 465,000 divided by 387,500. That's how that number came about. Okay, so let's see if it takes my two decimal places. Hey, it did. I put two decimal places in and it didn't mind. But if I would have left off one decimal place and rounded it to a whole number, it would have counted it wrong. Okay, so please keep in mind what they're asking you to find. Okay, moving on. Oop, let me out of there. Okay, moving on to number 7 now. Number 7. Some of these become a little more complicated, but we're going to try to take it one step at a time. Okay, so this is now this is earnings per share. So if you go back up and look at our list, By the way, we didn't do times interest earned yet. Okay. I don't know if they'll have us do that or not. What are we having? We're determining the earnings per share on common stock and price earnings ratio. Okay. So you would actually go down here and look, earnings per share and price earnings ratio. There it is. So we'll come back up here and look at what those are just as soon as I put these numbers in. Okay, so we have net income. Where do we get net income from? What statement? The income statement. Yep. They're just putting these in for us. Preferred dividends. Where are we getting preferred dividends? Well, that is in the equity section of the balance sheet. Okay, so that's where they're getting those. How many shares of stock are outstanding? So by the way, I am going to put numbers here. These are dollars, okay? But this next one is not dollars. Okay, this next one is not dollars. It's the number of shares outstanding. So shares outstanding. Shares of common stock outstanding. So outstanding means that those are in the shares. Those shares of stock are in the hands of the shareholders outside of our company. Okay, outside of our company. So if you learned a little bit about treasury stock in chapter 12, which is what we talked about, if we own any treasury stock, we don't pay ourselves. We don't pay our if we have shares of our own stock, we don't pay ourselves dividends. Okay, so we wouldn't pay dividends. So outstanding is different from the amount issued. All right. So the number of shares of common stock, and this is a number, this is not dollars. How many shares are out there? And they're telling us there are 65,000 shares out there, and I'm not going to put a dollar sign with that because that's the number of shares. Okay, and then finally, the market price per share of common stock. How'd they find that? Well, they went to Google and Googled what's the share price today for whatever this company is. Market price per share of common stock. Market price per share of common stock. So the first two things we got from our financial statements. You also could get the number of shares outstanding from a financial statement too. It would be from the balance sheet. That's why we keep the par value of our common stock and our preferred stock in an account for us. But the market share, you have the market price, you'd actually just have to go find how much is our stock selling for today. Okay, and I'm going to turn that to a dollar value. There we go. So that is $134.40 per share on the market. Okay, so out in the market, that's what that is. Okay, so now we're going to do earnings per share. It's also known as EPS, earnings per share. So it's going to, okay, and we'll look at the formula here in a minute, and that's going to be a dollar amount. Most of your Oh, okay. And then the other one is going to be a ratio. One's going to be a dollar amount and one's going to be a ratio. Okay, so this is going to be your price earnings ratio. Okay, so earnings per share. Let's go see what the formula is. Earnings per share. It says net income. We're going to subtract any preferred dividends for our numerator. And then we're going to divide by the number of shares outstanding. Okay, so this is going to be a dollar value. So we're going to take our net income and we're going to subtract the dividends that we sent out to preferred shareholders, right? preferred dividends. And then we're going to put that in parentheses, and then we're going to divide by the number of common shares outstanding. And that is right here. So we get how much earnings there are if you divide all those earnings by the number of shares outstanding. Okay. And I, once again, am going to make sure, and this is going to be a dollar value. Yep. So it looks like we've got $14 per share of earnings on a share of common stock. Okay. So, and I'm going to put that down here, how to, right? So per share of common stock. Okay. This is the market price per share, market price per share of common stock. No, that's the earnings per share. Sorry about that. We've already got the market price up there. This is the earnings. Earnings is what when we took our revenues minus our expenses. Okay, revenues minus our expenses. Okay, now we need the price earnings ratio. And I know you're probably getting tired of a lot of this stuff. We're going to take that market price, however much it's selling, and we're going to divide by our earnings per share. Okay, so we've just found the earnings per share. So we're going to need that. And let me go ahead and show you how it's calculated. I want to make sure to keep doing that. So we took $965,000 of net income, and we subtracted our preferred dividends and closed parentheses, and then divided by the $65,000 shares. So that's the shares there. These are dollars. I will go ahead and put dollars there because it does help to know that. Okay. And so by the way, well, no, I'm not even going to go there. There's the explanation. So now our price, right, which is the market price, they told us that our market price is $134.40. We're going to divide that by our EPS, which we just found. So our price earnings ratio, and let's double check, okay, is 9.6. Okay, 9.6. So be sure that's just a number. Okay, that's just a number. It's not a dollar. Okay, actually, that's how many times, right? Let me put this down. Number of times the market price number of times our market price is, okay, I'm trying to think of a good way to say this. Number of times the market price, let me go back. Okay, let me just see what it says here. I don't want to say it wrong. Okay, so once again, it measures future earnings, okay, future earnings prospects. It's the number of times that the market price is over our earnings, right? So you could say for every dollar, here's what you can say. I like to get it down to an easy way to understand it. For every dollar of earnings, okay, for every dollar of earnings, okay, the market share is $9.60. Okay, for every dollar of earnings, the market share price is not, so it's, our market share price is 9.6 times higher than our EPS. Okay, so yeah, the higher the better. Okay, the earnings per share, higher the better. Higher is favorable. Okay, so is this one. Whoop. Higher is favorable. It's good to know that. Okay, higher is favorable. Let's put this in. 9.6 times. One more time. If you took the market price and you divide by our earnings per share, that's 9.6 times our EPS. Okay, if this can get higher, we're doing even better. Okay, now let's go to 8. Okay, we're moving along here. Putting all the numbers in takes a little bit of time, but it's worth it to put it into this spreadsheet because you can usually find something quickly that you may have messed up on. Okay, this is going to be profitability analysis. And by the way, so is this. What did they call that last one? I want to put the label in. It's just profitability, earnings per share, and price earnings ratio. So EPS is what we were just finding, earnings per share and price earnings ratio. And that's profitability. Okay, that is measuring profitability. Okay, now we're just going to do a profitability analysis. Okay, and we're going to do return on stockholders' equity, return on common stockholders' equity. Return is the amount of money that you've earned on top of your money. Okay, yep. And when an investor invests in our business, they hope to get a good return on their investment, a return on their money. Okay, so this is going to be profitability analysis, but it's for common shareholders. So common stockholders, profitability analysis. Okay, so let's put these numbers down. So once again, we're getting the net income involved. Why? Because this is talking about return. Net income is the extra that we're able to hang on to after we subtract our costs. Okay, so I'm going to go ahead and put 1,178,000. Then we have preferred dividends again. That's how much we paid out to preferred shareholders. If you don't have preferred shareholders, then that number is not relevant at all. Then we have to find the average stockholders' equity, and there's a calculation to that, but they're giving it to us now. Okay, they're giving it to us. But if you have to find it, the book, the back in the pages of the chapter, it tells you how. Okay, and then the average common stockholders' equity. And so there's the average stockholders' equity, and then there's the average common stockholders' equity. Now that would be the same if all they had was common stock, but they've got preferred as well. Okay, so common stockholders' equity. So you have to think of it that way. Okay, and I'm going to put that number here, and these are dollars here. So 5,598,416. Okay, so now we want return on stockholders' equity. And then we want return on common stockholders' equity. So we're going to do one and then the other. But like I said, they've done quite a bit of the work for this one. And it may not be the case when we do our coursework. We may have to do a little extra here. All right, I'm going to go back and fix something real quick. I forgot to put how much I used to get my price earnings ratio. So let me do that. The market price back up here was $134.40. We're going to divide by the earnings per share that we found. So I wanted you to remember that that's how I got that number. Okay, now we're getting ready to do the return on stockholders' equity. So let's go look at the formula. This is a profitability measure. Return on stockholders' equity. Look, the return on stockholders' equity, you just simply use net income and you divide by average total stockholders' equity. But when they want it singled out down to just common stockholders' equity, you take net income and subtract preferred dividends and then divide by average common stockholders' equity. So that's why they gave us all those numbers. Okay, so let's go ahead and calculate. Okay, and this is going to be in dollars, and then I'll put how I get it. Okay, I'll put how I get it here. So let's do our net income, and we're just going to divide by the average stockholders' equity. So it shows a 0, but if I increase the decimal, there it is. Okay, and this is a percentage. Okay, so how do you go from a decimal to a percentage? You take this times 100 to get a percentage. It is 13%. And I'm going to put the percent sign right next to it. Okay, it's 13%. Now they want it to one decimal place. So I do need to, there we go. Need to fix that up a little bit. Okay, and now we're going to do the same thing for the common stockholders' equity. This time we're going to take net income and subtract the preferred dividends. We're going to put that in a set of parentheses. Okay, set of parentheses, and divide by the average. Yeah, this one. Okay, the average common stockholders' equity. So that is a 0 there. We're going to increase the decimals to see what it turns out to be. And then we're going to take this times 100 to find out what its percentage would be. So 20. And now once again, I'm going to increase the decimals. Okay, and I'm going to put the percentage sign next to it to show that, yep, it's got to be a percentage. All right, let's put 13.30 and 20.20. See how we did. Okay, now I'm going to put those amounts of how I got these numbers here. Okay, so the first one is net income of 1,178,000 divided by the number of, or the average stockholders' equity, 8,857,143. Okay, and then down here, got to go a little bit further. Okay, down here we got to take net income, okay, of 178, and we got to subtract the dividends, which is 47,120, and put that in parentheses, and then divide by the 5 million there, the average common stockholders' equity. Average common stockholders' equity. Okay, so this is 598,416. Okay. And by the way, these are all dollars. Okay, these are all dollars. Boop, boop, boop. Okay, fix it for me. Oh, I need another set of parentheses. Yep. Okay, let me finish. Got to have another set of parentheses. See, this is another reason why you take algebra. Yep. Is so you can learn to put things into a formula if you need it. Okay, then I need one at the end. All right. Oh, it still doesn't like it. Come on. What's wrong? Whoop. Okay. Let me try this. Oh, I know. I was just going to display it. Sorry about that. Let me try this one more time. Okay, we are going to put in net income, 1,178,000. Let me get my brain back in gear here. And then we're going to subtract 47,120. And we're going to put that in parentheses so we know how much that amount is. Okay. And then we're going to divide by the average shareholder, common stockholders equity amount, 5,598,416. Okay, so, and I know that really should be in another set of parentheses. So remember, you always work in the most inside parentheses first. So that's the number, that's the calculation to get this. Okay, just a couple more and we'll be done. All right, so this is called return on total assets, return. So just like we did return up here, it's going to be in their net income is going to be involved. Okay, net income is involved in anything that says return. All right, so this is number 9. We have net income of 747,860. Then we have interest expense, because I think we got to subtract it if my memory serves. Okay, 980. Okay, these I like seeing my commas in my big numbers. So come on. I can't. What is the matter? 747,860. Okay, there we go. 131,980. It's fine. They're in decimals. Little, there we go. Those are dollars. And then the last one is the average total assets. This one is a percentage also. Okay, just like those were percentages, return tends to be a percentage. So the average total assets. How would you get average total assets? You would have to look at 2 years at least in a row to get what that number is. They've done that work for us. I need to add another 0 to this. Okay, so they've done the work for us. Nope. There we go. All right, so once again, return on total assets. Return on total assets. So you buy all these things to build your business and to work in your business. Well, what kind of a return are you getting on them? That's basically what it's asking. So if we go up here and look at return on total assets, we need net income plus interest expense. Yep, we're adding back interest. And then we're going to divide by the average total assets. Okay, so your return on total assets is the number we're going to find. Okay, so here it is. So net income plus interest expense divided by your total average total assets. Okay, so there it is. Return. Nope, something's not right. Just a second. Okay, let me go back and do that. It should be a decimal. So if you get this, oh, I got to do if you don't do your parentheses where they go, it won't come out right. Okay, there we go. There is our decimal. Now I'm going to take it times 100 to get my percentage, times 100. And then I'm going to increase the decimals here so we can see it. Yep. And then I'm going to put the percentage sign next to it, so we know we've converted it to a percentage. 14.4, and they want it 1 decimal place. A lot of these, they want at least 1 decimal place. All right, let's check the work. Looking pretty good. 2 more. This is called asset turnover. What is the asset turnover? So we've had a couple already about turnovers. Turnover is how useful you've made, how much use you've made out of the assets that we have. Okay, so let's put sales down. Okay, 6,660,000. And we need average total assets. Now notice they are taking out long-term investments. So they've already done the math on that, but if we have to do the math, we are going to have to remove the if they have any long-term investments. So, and I'm going to put minus long-term investments. So that is something you would have to calculate if you're just given that. If you're just given the balance sheet, you've got to take those out. All right, so 3,330,000. Okay, so let me go back. I still didn't put in the amount. All right, let me show you what this one above here was. All right, 747,860 plus our interest expense of 131,980. Okay, and once again, those are in parentheses. Okay, and then we divide by our average total asset, 6,110,000. There we go. All right, now down here, let's go look at the formula. Okay, the formula for asset turnover. There it is. Sales divided by average total assets, but they've already done the extra calculation needed for that divisor there. So luckily we get to take a shortcut. So this is asset turnover, and this is just a number. How many times did it turn over? Okay, how many times? So we're going to take our sales and divide by our total, average total assets minus the long-term investments. Okay, now I'm going to increase. So we got a 2. Okay, so we turned those assets over twice when we made our sales, right? So basically our sales are 2 times as much as our assets. Okay, and I am putting 2.0 there because they asked for that. So the calculation is, okay, 6,660,000 divided by 3,330,000. There's where we're getting the 2. Okay, last problem for these intro. Last one. Thank goodness. Seems like there's a lot of these, but that's all right. We're just getting some exposure here. The last one is the times interest earned. Okay, so this is times interest earned. This is a solvency. So we're going back to one of the solvency measures. Solvency measure times interest earned. Okay, so we are going to use income, right? But it's a specific income. So this is the income that's listed on the income statement before taxes. Okay, before taxes. So there's a line on most income statements that report income before taxes and then after taxes. Okay, because taxes are just as much of an expense of doing business than anything else. All right, so I'm going to put this in times interest earned. Okay, so if we go up here and look, this is under solvency. You would think this would be profitability. You would think it would be profitability because it's using income, but it's not. It's considered a solvency measure. Remember, solvency is how well you can pay your long-term debt and interest. So we're going to take income tax the income before income tax expense plus the interest expense divided by the interest expense. Okay, so this plus this, then divided by the interest expense. So this is the last one we do for these intro problems. So, oh, I forgot to put in my numbers. Good grief. Hang on just a second. Okay, so I want to put in the income before income tax expense. There's actually an acronym that's used for this, income before income tax. That IBIT, that's what accountants tend to use when that's the number they're looking for. They gave this to us from the income statement, so we didn't have to figure it out. Okay, and then the interest expense. This measure is completely on the income statement. Yep, no other, you don't use the balance sheet for this one. Okay, so, and once again, this is just a number. It's just a number. Okay, so number of times. That's what we're trying to find. Number of times. How many times did we earn our interest? Our earnings are here. So now here we go. Our earnings, what are they? $2,385,900 divided by the interest expense. So we earned our interest expense 24.1 times. Okay, 24.1 times. So let's put that in, and then I'll make sure you know how this gets calculated. Okay, 24 point, hold on. What did I do? Maybe I keyed something in wrong. 2,385,900. Our interest expense is 900. Okay. Okay. Oh, I forgot to add. My mistake. Let's try this again. Sorry about that. Sorry about that. Okay. So let's try this again. Equals, open parentheses. Start with the income tax before income tax expense. Then we are going to add the interest expense. Close parentheses. And then we divide by that same number. Okay, there we go, 25.10. Sorry about that. 25.10. Now let's see if we're right. Okay, so now I'm going to put down how we got this number, and then we're going to be done with these intro exercises. So if you're done, or if you want to work, Monty, you just do whatever works for you. Okay, so here one more time is how we got the number. We take the income before income tax, which they gave us, and we add the interest expense to it in a set of parentheses. And then we divide by the interest expense itself. So divide by 99,000. Okay, so let me put my decimals in here because I don't like big numbers without decimals. I can't read them very well. Okay, so there it is. There's the formula or the numbers we used to get this number right here. Okay, that's it, guys. I will be putting out a video here in just a little bit, or let me give me until tomorrow. But these are due next Tuesday. Okay, when we meet again on Monday, we're going to do a final test review. And then when we meet on Wednesday, I am going to give you, I'm gonna work one of the projects that I've put out there. And we all have different numbers for our projects. So I'm gonna do part of it, or if I can do all of it, I will. Okay, but I'm gonna show you how it works. Or if I have a video about it, I may let you just watch that because I plan to get a video done before next week. So we'll see what happens. Or I'll do at least walk you through what I did in the video. So thanks for being with me today, or being together to get today. And we will see you again for the last two classes next week, right? Monday and Wednesday. So Jackson, Chris, have a good one. I hope you hope to see you in the spring. Hope to see you back in the spring. And if you can join us for managerial accounting, come on in. So I'm going to close out for now. So let me stop my recording. Bye, guys.